How's London?
Wet today.
Wet, as usual.
Actually, well, this summer's been really good. But now it looks like summer's finished. So we're in autumn now.
So quick, huh?
Yeah. How's Hong Kong?
Hong Kong's been really, really hot. I mean, like really sweaty hot. I was just going out for lunch and I was sweaty all. Have you lived in Hong Kong?
No, I've not lived in Hong Kong. Shanghai.
Shanghai. Okay.
Yeah.
Cool.
But that was when I was very young. So I haven't. I think I went back 2017. That was the last time I was in China.
Okay. Okay. Cool. Yeah. We've got about 19 people on right now.
Okay.
Oh, some people raised their hand already. I don't know why. Okay. If you can, please mute yourself. If you want to, we're going to keep these questions at the end. So Ling is going to do an intro, and then I have a few questions, and then we will spend the rest of the time doing the Q&A. See how far we can get. And I will give you guys the link afterwards. So if you want to contact the tax advisor, you can just fill the stuff in. I will send it directly to Link afterwards. So as I said, this is going to be recorded and it's going to be posted in the WhatsApp, etc. So okay, we've got 18, 19 people. So let's start anyway.
Okay. Jimmy, if you can give me permission just to share a screen, so I've got a short presentation.
Okay. Shall I make you a host?
You can do, yeah. Yeah, that would work.
Okay. Good. I'm not super good at this.
No worries.
Okay. Can you do that now?
Yep, I've got it now.
All right. Thank you. Okay, let me start by introducing Ling Yan. Ling Yi. He's a tax advisor from Grant Thornton. Grant Thornton is one of those big firms, like the number 6 in the world. They have over 130 offices around the world. And he's the private client tax lead individual. So he takes care of the China tax, the people in Hong Kong, China, and Singapore. He gives them UK tax advice. So without further ado, let's pass the time to Ling.
Hi, thanks, Jimmy. Can you just confirm you can see the screen?
I can see the screen.
Yep, great. Okay. Hi, everyone. So my name's Ling. I'm from Grant Thornton. I'm a tax advisor. And I'll be talking about pre-arrival planning, so tax planning that individuals need to do before they relocate to the UK. I know Jimmy has a bunch of questions to sort of ask, and quite a few of those will be covered during the presentation, but I'll answer those questions at the end. And then if there's more time, I'll take some more live questions too.
Okay. It's just that it's just been such a hot topic right now. There's so many people from Hong Kong planning coming over to stay because of the BNO visa. So without planning, I thought that was very dangerous because they don't know. Most of people on this call, they are my students, and they're not like a super investor. So they're just a normal person. So they haven't really done much of a thinking about tax planning, things like that. So that's why I want to invite you to come and maybe talk, enlighten us a little bit.
Yeah, and this is really important. Right, so if we get started. So my team, I'm in London Entrepreneur and Private Client Tax, and we deal with internationally mobile high net worth individuals. A lot of our clients are coming to UK. We provide advice on that. We can also provide advice on them leaving the UK tax efficiently. And while they're in the UK, we minimize the amount of tax they need to pay. We deal with individuals and their corporates. And depending on tax planning, we can also deal with their trusts and partnerships as well. As Jimmy mentioned, we're number 6 or 7 worldwide, depending on if you're looking at revenue or total employees. We're in over 100 countries, and we also have offices in mainland China and Hong Kong as well. In the UK, in London, we have something called the China British Business Group, which effectively is our China desk, and it's formed specifically to help Chinese clients. So I can speak some Mandarin, but I'm also supported by colleagues on that desk who are bilingual speakers as well, so we can deal with any language barriers. I'd like to start off with just a really typical case. So if an individual comes over on an investor visa, so if this individual, this is a high net worth individual, and they've got 10 million of worldwide assets, they will bring a couple million to invest through the investor visa that allows them to the UK. If you're on a P&L visa, you won't need that. The other 8 million is invested overseas, and it can generate a large amount of income per year. Now, what happens if they want to bring in large sums of money? They may want to bring in up to 1 million to purchase a property. They may want to bring in some more money to purchase investment property. And if they're entrepreneurial, they may also want to look at business opportunities, investment opportunities in the UK as well. So we think about tax. Why is the tax important? Well, if they are investing through the investor visa, that's going to be subject to UK tax, because that's the whole point. In order for them to be allowed to come to UK, they invest into the UK. However, the other 8 million, which is currently invested overseas, when they're living in the UK, that normally would be subject to UK tax. However, with the right tax planning, we can reduce that down to nil. And so just to reiterate, that means their overseas income and overseas capital gains should normally be taxed in the UK, and the rates are 45 and 28%. But with the right tax planning, we can reduce that pretty much to nil. So that's one of the important things to get tax planning. The other important reason is because of bringing funds to the UK. So if you're bringing funds to buy your own property, to buy investment property, or to invest in the UK, there can be a potential tax charge on that, depending on what the funds comprise of. And if it's income, that tax charge can be up to 45%. So it's really important to get tax planning, because what we can do with the right planning is to increase the amounts of what's known as clean capital. And when you bring clean capital into the UK, there's not a tax charge on that at all.
Okay. So can I just confirm that that is only for the people who are living in UK?
Yes.
Tax resident.
Yes. So if you're tax, this applies to people moving over to UK once you become tax resident. There is taxation on individuals who aren't tax resident, but they have UK assets like property, and I'll cover that a little bit later. So in terms of the rest of the presentation, we're going to quickly look at tax residence, domicile, and the remittance of basis taxation. So that's one of the tax planning points we can do. We can look at how to minimize the amount of tax in terms of bringing money into the UK, other tax reliefs and tax efficient structures like corporate structures, and we'll finish off with some case studies and key takeaways as well.
That's great.
So in terms of UK tax residence, it is quite complicated. There's a lot of different tests that we look at. However, I won't read out this whole slide, but the most important thing about UK tax residency is to work out when an individual becomes UK tax resident, because once they're UK tax resident, that's when they need to pay UK tax. That's when they need to declare things to the UK HMRC, the government body. Broadly speaking, in the UK, we operate by tax years. So that's the 6th of April to the next 5th of April. So you would normally be UK resident for the whole tax year. However, if you come in part way through, depending on the test and depending on the situation, you may be tax resident only part way through the year. And broadly speaking, the statutory residence test, the residence test here, operates on how many days you've been in the UK. And a day in the UK is actually a midnight. So if you come in one day and leave in the same day, you technically haven't spent any time in the UK. The more days you're in the UK, the more likely you are to be UK resident in that tax year. And it's important for tax planning, because ideally a lot of the tax planning we do works a lot better if it's done before you become UK resident, which is possible for you to be in the UK without you becoming a UK resident until the next April. In terms of domicile, the concept of domicile is an individual's connection to a country, and a person is domiciled in the country that they intend to live in permanently, they intend to retire in, they have the strongest connection to. So for individuals coming to the UK, who are coming to the UK for a temporary amount of time, that could be 5, 10, 15, even 20 years, it's possible for them to be resident in the country, but not domiciled. So individuals from Hong Kong who are coming over for 5 or 10 years, they will be resident, but they won't be UK domiciled. And the importance of domicile here is, if you're not UK domiciled, you have access to a different basis of taxation, which can be very beneficial to you. So this is the different basis of taxation. So if we look at the table, the top table, UK resident, UK domicile. So that's someone like me who's now living in the UK and probably going to live in the UK for the rest of my life. Anything that's UK arising, so UK income and gains, I need to pay tax to the UK on that. Fine. Anything outside the UK, so if I have rental properties in China or Europe and I get income from that, I also need to pay to UK tax authorities. So the UK gets everything. Now, if I'm an individual coming from Hong Kong who's living in the UK, I'm a high net worth individual, and I'm going to be taxed on the remittance basis because I'm not a UK domiciled individual. It's exactly the same for UK income and gains. Excuse me. However, for my overseas income and gains, that doesn't necessarily need to be taxed in the UK. You can file your tax returns under the remittance basis, and as long as the income or gains arises offshore and you do not remit those in that tax year or later, then you don't need to pay tax on that income. And that's the real bonus here. A lot of high net worth individuals who come to the UK, they'll have very little UK footprint, so they won't have that much UK assets, so they don't need to pay that much UK tax. And if they file on the remittance basis, the UK won't tax you on overseas income or gains. So that could be very beneficial.
So Len, but that person still lives in UK?
Yes, so that person can be UK resident, not UK domiciled. They can live in the UK and they can still file under this basis. So what we would do is we would need to take a review of their worldwide assets and a review of worldwide income, and we'll do a calculation. And this will tell us whether it's better to file on a normal basis or on this remittance basis. Now, there's a couple of drawbacks for the remittance basis. One is the longer you stay in the UK, the more you need to pay to be on the remittance basis. So if you've come to the UK and you stay in the UK for every year from that point, after 7 years, for the first 7 years, let's say, you don't need to pay any charge to be on the remittance basis. You lose a few tax allowances in the UK, but there's no charge to be on the remittance basis. After 7 years, you have to pay £30,000 just to claim the remittance basis. And after 12 years, that increases to 60,000. Once you've been in the UK for 15 years, your next year, you can't claim it anymore. So it can be very beneficial, but it doesn't last forever. And the longer you stay in the UK, the more you need to pay. So we will need to do a calculation every year to work out whether it's the right thing to do for that year. Now, the final drawback for remittance basis is you are taxed on the funds you bring into the UK. So this is why the tax planning here is important. If you don't pay tax on your offshore income and gains in the UK, that's fine if you file on the remittance basis. But if you then bring in those funds to the UK, you do need to pay tax on it. So if you bring in income, that could be taxed up to 45%. If you bring in capital gains, that's taxed up to 28%. Now, I mentioned before about clean capital. There's no tax charge to bring in clean capital, and that's what our tax planning will aim to maximize. So we would try to increase the amount of this clean capital funds. And this is a pot of funds that can be brought into UK with no tax charge, either the year you come in or any year afterwards. What's really important is for this clean capital is just to not taint it. You don't want any income or capital to go into the clean capital, because in terms of taxing, it's done on a worst case basis. So any income that goes in, that's taxed first before you can get any clean capital out of the account. So,
yeah, I just want to ask,
Jimmy, did you have? Yep.
Yeah, you mentioned clean capital. So, how do one know, or how do one get the capital to become clean?
So that depends on a number of things. We'll need to review what all the funds were. We need to also specifically in advance, we need to work out when someone becomes UK resident, because clean capital would only really match the funds before you become UK resident. And then we would need to work together with your bank to ensure that everything is mirrored and everything remains the same from the moment they become UK resident. So if with the right tax planning done in advance, you could be in the UK but not be UK resident for another month or two. So I guess gives us a chance to increase the amount of clean capital you have, and then to make sure your accounts are structured correctly. The main problem for a lot of clients who don't really know about a lot of the tax points is that they put income or gains into a clean capital account. And then once that happens, you can't reverse it. You can't just leave the UK and fix it. At that point, then you just have to suffer the tax consequences of remitting any funds from that account. So in terms of other useful tax points, when I mentioned about you need to pay tax on remitting income or gains, that is true. However, if you wanted to invest in certain businesses in the UK, then those funds can be brought in without a tax charge. There's quite complex rules about which businesses will apply or not, but that is something that's quite useful, because what you want to do is you want to use your clean capital when you need to live your lifestyle, and you don't want to bring clean capital to invest in UK businesses if you can claim business investment relief. Instead, you can bring funds that normally would be taxed, but if we claim this relief, it won't be. And then property often can be more tax efficient in some circumstances when you're receiving quite a lot of rental income. And that's because there's a lower corporate tax rate of 19% compared to 45% income tax if you held property in your own name. So the corporate share or corporate structure can be very beneficial for this. It can also be beneficial in terms of purchasing property as well, but it just depends on the circumstances. The issue is when you want to get those funds out of the company, profit extraction, we need to do a calculation to see whether long term it is more beneficial or not. And I'll quickly go through inheritance tax. So inheritance tax is a charge on when someone passes away when they have assets. For UK resident non-domiciled individuals, only the UK assets will be subject to this inheritance tax, and that could be up to 40%. Overseas assets won't be covered by inheritance tax. However, the longer you stay in the UK, the more risk that you acquire a domicile in the UK or you become deemed domicile in the UK. So you've been in the UK for more than 15 years consecutively. UK inheritance tax then becomes chargeable on all your assets, not just your UK ones. So that does increase tax exposure severely. What we can do in terms of tax planning is before this event happens and you still want to stay in the UK, we can use a couple of tax vehicles which can protect assets within that structure. So an excluded property trust is one of those that would protect those assets from UK IHT, even if the individuals or yourselves then become domiciled in the UK later. And then finally, on a couple of quick case studies. So this is a really good scenario. This is a scenario we'd like to see. So we've got an individual coming to the UK. They came to the UK in 2019, and we're able to advise them in advance of them coming to the UK. So this is Mr. X. We looked at their UK resident situation. They came in. However, we worked out that they would only be UK resident from the following April. That gave us a lot of time to implement tax planning. We also worked out that the remittance basis is going to be much more beneficial to their personal circumstances. So their UK tax footprint will be decreased by claiming that. And because we had a month or two to do a lot of the tax planning and work with his banks, we're able to maximize the amount of clean capital. And he moved a lot of these funds to the UK to buy his own property and to buy an investment property as well. And there was no tax charge on that because we're able to review the position, to create the clean capital, to document it all. And so anytime later, if HMRC ever asks, we have all the evidence there to show that the funds brought in was clean capital and no tax on that. Now, this is another situation which unfortunately is not that rare. It does happen. So we got Mr. Y. He was introduced to us a couple of years back, but he originally came to the UK in 2012. So he wasn't that aware of UK tax rules. He had a local accountant, and over the years, he brought in about 4 million to buy UK properties and to fund his lifestyle. Now, when we reviewed the situation, the reason we were introduced to the client is because he had an HMRC inquiry, and HMRC had contacted him to ask him, you brought a lot of funds into the UK, can you confirm to us you don't need to pay tax on that? Now, because Mr. Y was very wealthy, he was filed under remittance-based taxation. And if you remember, that is beneficial, but you have to be very careful about what funds you bring into the UK or not. So because he's remitted about £4 million to buy properties, HMRC know this because there's a land registry, so they know which individuals are purchasing properties. That's most likely how HMRC contacted this individual. Now, when we reviewed what had happened and what he remitted and brought into the UK and which accounts they came from, we found a lot of them came from what's known as a mixed account. So a mixed account is something that has clean capital, has income and capital gains. Essentially, a mixed account is an account that doesn't just have clean capital. When we looked into it very carefully, around about half of the amounts of money that brought to the UK were from either income or gains and not just clean capital. And that's because you're taxed on income first. All the income's taxed first, then all the gains before clean capital. That means up to 2 million of the funds I brought to UK can be taxed up to 45%, which is really unfortunate. And HMRC are already seeking the underpayment of tax. They want penalties, they want interest. And it's very expensive to resolve the position because this tax planning, we look at the accounts, we have to look at it line by line and go back all the way up into 2012. And also, it's really unfortunate because this situation is entirely avoidable if the right tax planning was done. So if we had seen this individual early on, we would have segregated out and said, look, we've done the tax advice. This fund you can bring in to buy your properties. Your other income gains can go into another account. So we can segregate it.
Okay.
And I think this really highlights how important it is to do the right tax planning. And just to summarize the very end, so my key takeaways from this, if you remember this slide, this is the most important slide. The UK is a very attractive destination, especially for BNOs now, because they don't need to go through the investor visa process anymore. And the UK can be very tax efficient for high net worth individuals. However, the tax planning is just so important because with the right tax planning, we can minimize the tax liability and we can make sure that you pay little or no tax on bringing it into the UK. And it's just so important to do this in advance because once you're in the UK and things have happened, we can't reverse time and we can't undo those things.
Thank you. Thank you. I would just like to summarize it because a lot of people ask me the same thing. For non-residents, if they just go buy a property in UK for buy to let or whatever, HMO. So if they buy in a limited company, one limited company, one house, that's the structure I normally say that should cover quite well for most people, just for buy to let stuff, unless you're trading the property. For people who are planning to come over, once they become a tax resident, even their income from Hong Kong is taxable, like the rent, the pension, the insurance plan, the retirement fund, the cash gift, all this cash stuff is taxable once they start living in UK. Is that correct?
Yeah, so I'll address all these points. So in terms of individuals investing in the UK in property, it is important just to review the situation to see if it's better off in the corporate or in the personal situation. But yes, that is a very common vehicle to use. In terms of individuals who then relocate and come to the UK, they're resident in the UK. Technically speaking, once they're living in UK, all their worldwide income is subject to UK tax. That includes rental, retirement, pensions, any income in Hong Kong. However, if we review their situation, it may be that it's more beneficial for them to be taxed on a remittance basis because that will limit their UK tax exposure to just the UK side of things. And if you imagine, if someone's got, let's say £2 million, they're living in the UK now, they have a job in the UK, but it's not paid that highly, but it's more of a lifestyle job. And actually most of their 2 million is invested in Hong Kong and it generates either capital gains or income every year. In that case, that person pays minimal tax in the UK because there's not much UK tax due because most of their income is from overseas. And if they file under the remittance basis, then that overseas income isn't taxable in the UK. It may still be taxable in the country that the assets are in, but it won't be taxable in the UK under the remittance basis.
They have to do that before they come to UK or once they come to UK?
So no. So the remittance basis, so there's a few things here. If we know in advance they're going to be on the remittance basis, then we need to do all this tax planning before they come to UK because once they're resident in UK, we can't create any more clean capital from that point. It becomes very difficult to. So a lot of that tax plan needs to be done in advance. However, you do have the luxury of waiting until the 31st of January after the end of the tax year to file your tax return. So after the end of the tax year, we can then do some calculations, work out every year whether it's better to be on a remittance basis or not. So some years, if they know that they're not going to have any or very much offshore income or gains in that year, we can then look at that year and say, okay, we don't need to file on a remittance basis for that year then. So it's a year-on-year process.
Okay, understand. Do you have time to talk about a question or no?
Yeah. So that's fine. I think I probably have another, let's say 25 minutes or so. I know you've sent me a few questions. I'll quickly talk about those. And then if there's time, I'll take a few more questions. So I'm just going to read out the questions you sent me. So the first question is about capital gains tax on property. If an individual moves to the UK before selling a property that's based in Hong Kong, what happens for capital gains tax? So that's quite a complicated question. If they've been living in that property in Hong Kong, that's their main residence, and maybe once they're in the UK, they don't need to pay any additional tax. Now, with property that's in Hong Kong, we have to look at two different tax rules because we need to look at rules in Hong Kong or we have to look at rules in the UK. I'm only going to comment on things on the UK. If they're living in it, they've always lived in it, it may be the case that there's no tax due. If that property in Hong Kong was for investment purposes, they never lived in it, there will be capital gains tax. However, if they file under the remittance basis, the capital gains tax that's due in the UK on offshore income doesn't need to be paid. There's no tax due. But then those funds that he gets from selling that property, those funds can't come to the UK without having to pay a tax charge. And that tax charge later is going to look at either 18 or 28% because those are the higher rates of capital gains tax for UK purposes. Now, if they've already paid some tax in that country, so in Hong Kong, we'll have to look at the double taxation treaty, but it's likely that we can use the tax already paid in Hong Kong to decrease the UK tax bill. So you generally will not get taxed twice. But for that, it would depend on, we will have to look at the circumstances and we'll have to look at what funds that person needs in the UK. Because if they're going to bring it to the UK anyway, there's no difference between being on a remittance basis or not because they're going to be taxed on it. The next question is just about capital gains tax on investments, so equities. So there's not that much difference between equities and property if we look at holding properties or holding equities for investment purposes. It's going to be very much the same. So is capital gains tax going to be a portion on the number of years that you're living in the UK? So no. For UK tax purposes, if you dispose of something while living in the UK, you need to pay capital gains. Capital gains is going to be the difference between the amount of money you sold it for and the amount of money you bought it for. The number of years in the UK will not change at that point. And if anything, it becomes more complicated because you're looking at two countries, two taxation rules for different countries, whether you're allowed to use a credit from Hong Kong tax against the UK tax, and also exchange rates. So for UK tax purposes, we will need to look at the exchange rates on the day you bought it and the day you sold it for sterling only. Whereas I believe for Hong Kong, it would be in Hong Kong dollars only. So you may have a gain let's say you may have a loss for Hong Kong tax purposes. However, for UK tax, depending on the sterling exchange rates, you may have to pay tax even though you haven't actually made any money in Hong Kong. So it gets even more complicated at that point. The next question is just about, let's see. So if you sold your property in Hong Kong 3 years after coming to the UK, but the property was let out in Hong Kong during this period, the rules about letting and capital gains tax have changed in the UK, so you don't get a relief anymore for letting out a property unless you were living in that property at that time. And in terms of, so that for disposal and remitting money and remitting, so the question is, how about if we dispose the property, it was remitted to the UK into a UK personal account, from an offshore personal account to a UK limited account for investment purposes only, is this subject to remittance tax? So if they're on a remittance basis and that happens, then yes. So the remittance basis is complicated. There's lots of ways that individuals feel they can get around it because their friends transfer things to them, or maybe it's not to them, it's to their family members, or maybe it's to a corporate. For UK tax purposes, we have to look at the reason the amounts being brought in, and whether it matches to an actual benefit for the individual. So if the intention is to benefit the individual who, if they brought in the money themselves from offshore, they would be taxed on it, then it will be taxable. There's very specific rules on gifts, which I won't go into now, but gifts can be used, but it's very, very complicated. So for this instance, if an individual remitted from their personal offshore account to their own limited company in the UK for investment purposes, is this subject to remittance tax? If they're on a remittance basis, yes. If they're for investment properties, most likely yes. However, as I mentioned before in my presentation, there's business investment relief. So on business investment relief, you may normally need to pay tax, but depending on what you're investing in, you don't need to if the relief applies. So it would need to look at the circumstances. For pure investment properties, then that wouldn't qualify for the relief. But there are ways for other trading companies to qualify for the relief.
But the company they're investing in is belong to them. That doesn't qualify.
No, that won't change anything. If anything, you can still get business investment relief even if it's your own company. It just needs to qualify for business investment relief. So pure residential property. So if you're just holding companies in SPVs, one company, one property, or many properties, one company, that wouldn't qualify for that relief. But certain other things like a trading business, which has assets, that would qualify.
Okay.
Yeah, those are the ends of your questions, Jimmy. But I do have some time to field any other questions.
好，如果大家有咩問題咧，未 cover 到啦，你可以而家舉手打出嚟又得，你想講又得，你自己。Let's see if we get any response.
Okay.
I've got questions, but they're similar. They're all talking about once they arrive in UK, if they have a rental income from Hong Kong, things like that. So all this basically, all this are cap tax, all income. Because I thought income tax is only based on UK. If I earn my income from overseas, it's not income tax. I guess I'm wrong.
No, that's not quite correct. So the important thing is when someone's UK resident, once they're UK resident, they strictly speaking pay tax to UK on everything. Remittance basis is a claim that we can do to exempt them from paying UK tax on offshore income and gains, but it comes with some drawbacks. As you can see, it's not easy to bring in those funds without having to pay the tax anyway. So only really benefits the individuals who have a lot of clean capital, they can live on that, and they don't need to bring in any income or gains once they're living in the UK to the UK. That is the general basis.
Okay, even for pensions or retirement money they get.
We would need to look at specific kinds of income, but in general, then pension income is going to be taxable in the UK. Rental income is going to be taxable in the UK, offshore rental income, offshore pension income. What normally sometimes can happen is if the tax rates are similar, so let's say they need to pay 20% tax in China on their pension income before they get the money, so they get the money net of tax. For UK tax purposes, they need to pay tax again. However, if they're only going to be subject to 20% tax in the UK, instead of 40 or 45%, then what can happen is if the double taxation agreement allows it, the tax paid in China is already taken into account for UK tax purposes, and so no additional tax is needed. And so technically then, the net amount of pension income they've received in China, they could bring into the UK, and they don't need to pay any more tax on it because the tax is already paid. But that really just depends on per tax year, what the tax rate on that individual is. In the UK. So that's, again, a year-on-year assessment. And this is an important thing that with this kind of tax advice, you need to do quite a lot of work before they come to UK to set things up. And also you need to do some work every year to see what is best for them to do per year, because things can change and also tax rules can change. So the UK tax rules do change every few years, and later on this year, potentially spring next year, there may be quite a lot of changes which can impact non-domiciles in the UK.
Okay. Is the income from overseas, the rate is it's the same if it's from a pension firm or say from a rental income.
So that will depend on whether you're going to be filing on a normal basis or the remittance basis.
So it really depends on the individual. There's no one clean cut at all.
No, because depending on the kind of income, it's treated differently if you're on the arising basis, a normal basis, or on the remittance basis. However, the bands are roughly the same. So for the first £50,000, generally, the first £50,000 is going to be taxed at 20%. The next £100,000 is going to be taxed at 40%, and then 45%. However, if you're on the remittance basis, then sometimes some types of income may not be taxed at 40%. Instead, it'll just be taxed at 45%. It really just depends on per year what's going on.
Also, for the remittance, there's no bands. It's just one-off.
There are bands. So a remittance basis, what we would look at is what do they need to pay in tax to the UK normally for that year, for that tax year? How much tax do they need to pay? Are they in the 20%, 40%, or 45% band? Then any remittances in the same tax year. And this is where it's difficult because obviously you're remitting funds in the tax year, but we don't know what's going to happen by the end of the tax year. So this is why there's a lot of planning needed. You have UK tax already. Your remittances will then top up that UK tax higher. So if you're in the 20% band only for the UK tax, then any remittances will be taxed at 20% up until you've used up the whole band, and then it's going to be a tax at 40 or 45%. The reason sometimes you can skip different bands is because the nature of income can change. So if you're on the rising basis, it may be taxed at a slightly lower band than on the remittance basis. But the top rate of tax for both sides, whether in the rising or the remittance for income, is going to be at 45%.
So 你哋有冇未答嘅？如果有咧，就盡快啦，盡快，因為佢做翻多時間佢可以。So I'm not sure if anyone would ask any questions. So please,
Jimmy, let me just put the host back to you because I think some people have raised hands. Could you just direct me on how to send the host back to you?
You just click my picture. You can click the right 3 dots.
Okay, I've just passed host back. So I think you should see some questions.
Hi， 邊個？
我可唔可以講？
請講你個名。
Jenny 啊。
Jenny 你好，請講。
我係，因為我啲英文麻麻地。
你講中文先啦，你講中文先。
想問咧，如果香港即係喺 UK 嘅親人咧，即係調翻轉啦，我當我移民咗去 UK 啦。咁香港有親人過世，咁佢啲遺產係咪都要納遺產稅㗎？香港嗰個人咧就唔係
明白。So she asked that she's living in UK now, and her relative died and left her inheritance. Is that going to be inheritance tax?
What assets were held by that relative, and were any of these assets in the UK?
No, the assets not in UK. The assets in Hong Kong. She's living in UK. Her family died in Hong Kong.
Okay.
Left her assets.
In general, no.
In general.
There won't be any tax. There won't be any inheritance tax in the UK. There's no UK assets, and that individual didn't live in the UK. If you receive anything from the estate, it shouldn't be subject to any UK tax. It shouldn't be to income or gains. But it's complicated. So if you assets you had any involvement in, so for instance, if there was a family investment company or a family business where you worked in that business and created value for it, then you may be subject to tax.
Jenny，
係。
即係佢話，如果你係親戚或者你啲親人留俾你嘅咧，而 而留俾你嗰啲嘢咧，你係冇關係嘅，即係唔係你有份嘅，即係你冇喺嗰度做過嘢啊啲咁嘅嘢啦，就咁留俾你啦，你就冇遺產稅嘅。
我如果有份就要嘅。係
啊，有可能啊，有可能，即係。
係咁啊兩個名嘅，咁是第一個唔喺度，咁嗰個係咪都係當係一個？唔係，咁嗰個遺產留俾你咯，係咪一半係你㗎？係咯，即係譬如長命契嗰啲咯，我解釋。咁另外咧，就算當我冇份啦，當我即係簡單啲啦，冇份。如果我係物業嚟嘅，咁我承受咗物業之後，我賣出去，使唔使俾 capital gain 咧？即係嗰個。Okay. Say is a property. She inherited property and then she sold the property. Does she have, when she want to bring the money back to UK, does she have to pay tax on it?
Broadly speaking, yes. If she got a property, she doesn't need to pay tax on getting the property. But if she then sold the property and there was a gain there, that would be subject to UK tax.
But that is due to inheritance. The property is due to inheritance.
Yep. So if the tax point for this is when she receives an inheritance, she doesn't need to pay anything. But because she's got this asset now, if she then sells the asset and there's a gain, then she does need to pay tax on that. So that asset isn't free of tax forever. So if she changed it into liquidated it and there was a gain, then she would need to pay tax.
Jenny， 咁即係假如果你賣咗之後咧，你就將啲錢攞翻嚟英國咧，係會有稅。OK。譬如佢買咗30年前嘅樓價同而家樓價交換。唔關事，係你遺產俾咗你之後，你賣咗，你賺到嘅錢，你攞翻嚟。
Jimmy, there's a few questions. I just opened the chat here. So I think it was just sent to me because I was hosting at that point. So got a question from Wong P. If I own a Hong Kong company which owns Hong Kong property, if I don't receive any salary or dividends from this company, the profit of this company will not be subject to UK tax. Am I correct? So I'm assuming, Wong P, that you're living in the UK. So if you have that company that holds the property, if you're not receiving any salary and dividend directly from company, then generally you won't be subject to UK tax. However, it becomes more complicated because what is happening with the company is the company just rolling up the amount of money and not paying anything out, because it could be worse for an individual to do that because all they're doing is delaying the tax until the later date. Whereas if you took a small amount of profit per year, then effectively you could be paying a slightly lower tax rate. The next question is from Bonnie Wong. So what is the meaning of clean capital? Does this mean we need to provide funding proof, otherwise it will be taxed? So clean capital is just a term of money that you have that we've reviewed, and we can say that there's no tax due. So it's not really, doesn't really have any meaning other than that. Generally speaking, a lot of the money that you have before you come to UK, that will be clean capital. The problem is, if you have accounts that have clean capital, then you come to the UK and you're on the remittance basis, and then any income, any gains, or someone sends you money which is money they owe you, that could be income. As soon as anything goes into the account with your clean capital and effectively taints it, then when you're remitting from that account, it's no longer clean capital, you need to pay tax. So if you have, let's say, 100 million of clean capital, and then you have 5 million of income going into that account, when you're remitting, you need to remit more than 5 million before you can get any of that clean capital out. So you effectively can really make a bad position with your clean capital account if anything goes in that is in clean capital. And we would need to review what your worldwide income is, what assets you have, and then segregate your accounts properly to create the clean capital. It's not something that's very easy to do without looking at a full review, and it becomes very, very difficult to do that once you become UK resident as well. So that's why you need to get this advice done, ideally before you live in the UK. Okay. So I've got from Stella, is it better to dispose of residential property in Hong Kong and put the cash in account 1, then not subject to any tax when we enter the UK? After landing, income or gains should be put into account 2 and 3 respectively. Is that correct? Broadly speaking, then yes. But it just becomes very complicated. If you're basically disposing of a property and then quickly coming to UK and become a UK resident, we need to check that you're not already UK resident. For instance, if you came into the UK in March, you're probably not resident until the next April. But if you come into the UK, let's say in July, you may actually already be resident in the UK for UK tax purposes in the previous April. So if you sold something in April or June, then came into the UK July, August, September, for UK tax purposes, you may already be UK resident from April. So your disposal, your transaction will have occurred when you're UK resident, so there will be tax. So there is no easy answer. We will need to look at everyone's situation specifically because there's quite a lot of different overlapping parts.
Okay, for this example, so they don't have 183 days before they become a resident.
So 883 days is the simplest rule in the statutory residence test. If I just quickly show you all the rules, I'm not going to go through them, but there's 3 rules for each main test. There's 3 main tests. And each of these rules has a lot of sub rules. So the simplest one is if you're going to be in the UK more than 183 days, and when you say days is midnights, if you're in the UK for more than 183 midnights, you're UK resident. Anything less than that, but above 16 days, you may or may not be UK resident. We'll need to look at a lot of facts. We need to look at a lot of your ties to the UK as well, whether you've worked in the UK, whether you've been UK resident any of the previous 2 tax years, whether you have family, dependent family in the UK, whether you have accommodation available to you, whether you do more than 3 hours work for more than 40 days, and whether you've been in the UK for more than 90 days in any of the previous 2 or 3 tax years. It gets very, very complicated. So the simplest thing is not just 183 days. It gets way more complicated.
All right, thank you. Any more questions from your side?
No, those are all the questions.
Okay, Norris, do you want to, you put your hands up. Do you want to ask a question? No, I guess no. Okay, I don't think I've got any more questions from our side too. So I think we'll wrap up, and yeah, thank you very much for coming. I will leave a link for everybody, so you can type in your details, and I will send it all to Ling if you're interested to ask him for more questions. Just the last question, the general question. I know I asked you this before, but what group of people will be highly beneficial of paying you to be their tax advisor before they come in? I mean, if someone's just going to buy a 100K house rental, is it worth the while, or roughly how much assets and cash would they need to bring before they start worth the while?
Right. So that's a very good question. Because Grant Thornton, I work for Grant Thornton, and we're quite a large firm, then we do have a kind of minimum fee. And our fees, what I would say is it's not directly dependent on how wealthy an individual is. It's more what they want to do and how much money is involved with that. So for an individual they're just going to be moving to the UK, they have maybe $500,000 in total assets and wealth. They're going to buy a property here to live in, and that's basically about it. They don't have that much assets outside of the UK at that point once they got the UK property. For that's probably where we're not going to be commercial in terms of advising that person. They will still need tax advice, but perhaps we won't be the most commercial to give it. However, for an individual, certainly if they're coming over to the UK on an investor visa, they would definitely need my help and need tax advice. For an individual who's coming over on a BNL, it depends on what offshore income they are and whether it would be beneficial for them to be on a remittance basis. There's no easy answer to that, but if you do have significant assets, so several £million worth of assets, and that's all offshore, and in that case, it will be more beneficial for us to have a look at it to see if we can file under the remittance basis. And especially for individuals who they may not be relocating to UK, but they're serial investors and they like to buy property, then it becomes important for us to have a look at their situation, whether they want to buy property, whether one property per corporate vehicle is the better option, whether a holding company or other structure may be better. And inheritance tax is something that individuals don't really think about at all. But if you're an individual who comes to the UK, you're not staying, you just come over and you buy £2-3 million of property, £1 million of property, and then you leave. If you pass away while not living in the UK, the property you've got in the UK is subject to UK inheritance tax if the value of that property exceeds 325,000, and anything exceeding 325,000 will be subject to inheritance tax at 40%. That's something that a lot of individuals don't really consider, and it's something that we do need to highlight and look at, because if they want to invest, there's certain assets in the UK they can invest in but won't be subject to UK inheritance tax. Now, unfortunately, residential property will be subject to UK inheritance tax, especially if it's situated in the UK, it will be. But if they want to invest in other things that generate returns, such as businesses, such as trading businesses, a lot of that isn't necessarily going to be subject to UK inheritance tax. So for my example, if they're going to invest 10 million, they could be paying up to 4 million tax on that, broadly speaking, if it's all in property. But if they invest in some property and then invest in other businesses, the property will be taxed the UK inheritance tax, fine. But if they're investing 1 million in property and 9 million in trading businesses, and we do some tax work and we can work out those trading businesses won't be subject to UK inheritance tax, then it won't be a problem.
Okay, right. I think I've got it. So basically, anyone who's taking more than $500,000 into UK, definitely go and check you out and ask some questions, see if you can help.
Yeah, I mean, I'm always really happy to have a conversation. I would say that anyone over $500,000 or so, they would benefit from some tax advice. But if we look at the situation, I probably won't be the most commercial. But anyone coming over with more than $1 million, more than a couple of million, would definitely benefit from advice from me. And anyone who's looking to bring significant funds into the UK, they definitely need some tax advice. You want to have brought clean capital to UK. You don't want to have brought funds which 2 years, 3 years later on,
Yes.
you find out you need to pay 45% tax, because at the end of the day, you're going to be paying a lot more than 45%. You need to pay the tax. You have a pay or penalty, which can sometimes be 100% of the tax. In that case, you're basically paying 90% of tax plus interest. You could be paying more in tax than the money you brought in. It can be a very bad situation. So if you're going to be bringing money into the UK and you're going to be coming to live in the UK, you need tax advice.
Yeah, it's so important because most large people come from Hong Kong. They have such a simple tax rules, and now they're coming to UK. They didn't realize that the UK tax is so complicated.
Yeah.
Okay. Thank you for your time. I think we could maybe we do this again. Maybe we're not. Let's see how it goes. But I will definitely send you a list of the people who are interested to contact you. I'll send you. Okay. Thank you very much. Cheers.
Thanks very much, Jimmy. Thanks, guys.
Thank you.
Bye-bye.
Bye. Bye.